If an underlying asset has a low volatility, then an option on that asset would not have much value to the holder. Volatility most frequently refers to the standard deviation of the continuously compounded returns of a financial instrument with a specific time horizon. It is often used to quantify the risk of the instrument over that time period. Volatility is typically expressed in annualized terms, and it may either be an absolute number, for example $5, or a fraction of the mean, 5%. Volatility can be traded directly in today's markets through options and variance swaps. For a financial instrument whose price follows a Gaussian random walk or Wiener process, the volatility increases as time increases. Conceptually, this is because there is an increasing probability that the instrument's price will be further away from the initial price as time increases. However, rather than increase linearly, the volatility increases with the square root of time as time increases, because some fluctuations are expected to cancel each other out, so the most likely deviation after twice the time will not be twice the distance from zero. More broadly, volatility refers to the degree of, typically short-term, unpredictable changes over time of an asset. As such, volatility reflects the degree of risk faced by a trader with exposure to an asset. Volatility versus direction. It is important to recognize that volatility does not measure the direction of a trend, only its magnitude. This is because when calculating standard deviation or variance, all differences are squared, so that negative and positive differences are combined into one quantity. Two instruments with different volatilities may have the same expected return, but the instrument with higher volatility will have larger swings in values at the end of a given period of time. It goes without saying that since volatility is much greater when markets are open, the market convention is to measure volatility in trading days rather than calendar days. Hence we assume 252 trading days in a year. Here, it is important to remain consistent. Why do we quote volatility? Volatility is important not only as a major pricing parameter in the valuation of options, but it is also used as a relative value metric when comparing different option contracts. Moreover, in the currency markets, since the Black-Scholes model is universally accepted, traders quote option prices in terms of volatility. This enables a more efficient delta-neutral hedging platform, which eliminates the execution risk inherent in trading live premiums in a rapidly moving market. How can we derive a quick and dirty percentage volatility measurement? Suppose you notice that a market price index, which is approximately 1000, moves about 10 points a day on average. This would constitute a 1% up or down daily movement. To annualize this, you can use the rule of 16, that is, multiply by 16 to get 16% at the overall annual volatility. The rationale for this is that 16 is a square root of 256, which is approximately the number of actual trading days in a year. It follows, therefore, that the annualized volatility is bigger than the monthly volatility is bigger than the weekly volatility, and the weekly volatility is bigger than the volatility on a daily basis. The VIX is an index which measures expectations of volatility, or fluctuations in price, of the S&P 500 index. Higher values for the volatility index indicate that investors expect the value of the S&P 500 to fluctuate wildly, up, down, or both, in the next 30 days. The VIX is also called the fear index, because a high VIX represents uncertainty about future prices. It is calculated using the price of near-term options on the S&P 500 index. Because the value of an option is closely linked to the expected volatility of its underlying security, options prices can be a useful indicator of investors' expectations of volatility itself. Although the VIX is often called fear index, a high VIX is not necessarily bearish for stocks. Instead, the VIX is a measure of fear of volatility in either direction, including to the upside. In practical terms, when investors anticipate large upside volatility, they are unwilling to sell upside call stock options unless they receive a larger premium. Option buyers will be willing to pay such high premiums only if similarly anticipating a large upside move. The resulting aggregate of increases in upside stock option call prices raises the VIX just as does the aggregate growth in downside stock put option premiums that occurs when option buyers and sellers anticipate a likely sharp move to the downside. When the market is believed as likely to soar or as to plummet, writing any option that will cost the writer in the event of a sudden large move in either direction may look equally risky. Hence, high VIX readings mean investors see significant risk that the market will move sharply, whether downward or upward. The highest VIX readings occur when investors anticipate that huge moves in either direction are likely. Only when investors perceive neither significant downside risk nor significant upside potential will the VIX be low. What is the difference between implied and statistical volatilities? Implied volatilities should be viewed differently from statistical volatilities, even though they both forecast the volatility of the underlying asset over the life of the option. The two forecasts differ because they use different data and different models. Implied methods use current data on market prices of options, so the implied volatility contains all the forward expectations of investors about the likely future price paths of the underlying. Also, due to the Black-Scholes assumptions, this method assumes that the underlying price path is continuous. Contrast this with statistical methods, which use historic data on the underlying asset returns in a discrete time model for the variance of a time series. Let us now look at realized, respectively, actual volatility. This is a historical volatility calculated looking backward when an option has expired. As an example, let's say a trader wants to write an option today that expires in 3 months' time. To estimate the volatility, he might calculate the historical volatility of the past 3 months. The actual volatility will, however, only be known at expiry. Once the 3 months have passed, one can calculate the realized volatility, i.e. the actual variance, between the original trade date and expiry, because the actual price path is then known. How do we relate implied volatility to historical volatility? It is helpful to note that implied volatility is related to historical volatility, however the two are distinct. Historical volatility is a direct measure of the movement of the underlier's price, i.e. realized volatility over recent history, e.g. a trailing 20-day period. Implied volatility, in contrast, is set by the market price of the derivative contract itself and not the underlying. Therefore, different derivative contracts on the same underlying have different implied volatilities. For instance, an IBM call option struck at a strike of $100 and expiring in 6 months may have an implied volatility of 35%, while the put option struck at $105 strike and expiring in 1 month may have an implied volatility of 38%. At the same time, the historical volatility for IBM for the previous 21-day period might be 34%. Remember, all volatilities are expressed as annualized percentages. How can we use implied volatility as measure of relative value? Often, the implied volatility of an option is a more useful measure of the option's relative value than its price. This is because the price of an option depends most directly on the price of its underlying security. If an option is held as part of a delta-neutral portfolio, that is a portfolio that is hedged against small moves in the underlying price, then the next most important factor in determining the value of the option will be its implied volatility. Again, let me stress that implied volatility is so important that options are often quoted in terms of volatility rather than price, particularly between professional traders. Can we look at implied volatility as a price then? Another way to look at implied volatility is to think of it as a price, not as a measure of future asset moves. In this instance, it is simply a more convenient way to communicate option prices. Prices are different in nature from statistical numbers. We can estimate volatilities of future underlying returns using any of a large number of estimation methods. However, the number we get is not a price. A price requires two counterparties, a buyer and a seller. Prices are determined by supply and demand. Statistical estimates depend on the time series and the mathematical structure of the model used. It is a mistake to confuse a price, which implies a transaction, with the result of a statistical estimation, which is merely what comes out of a calculation. Implied volatilities are prices. Seen in this light, it should not be surprising that implied volatilities might not conform to what a particular statistical model would predict. Let us now explore the volatility surface. The first thing to note is that there is no unique volatility input to price all options on an underlying asset. Option volatility will depend on A. the tenor of option contract. This is referred to as the term structure of volatility. And B. whether the option is at, out, or in the money. This gives us what is known as volatility smile and skew. Hence, one needs a complex volatility surface to price options. Let us first look at the term structure of volatility. For options of different maturities, we also see characteristic differences in implied volatility. However, in this case, the dominant effect is related to the market's implied impact of upcoming events. For instance, it is well observed that realized volatility for stock prices rises significantly on the day that a company reports its earnings. Correspondingly, we see that implied volatility for options will rise during the period prior to the earnings announcement and then fall again as soon as the stock prices absorbs the new information. Options that mature earlier exhibit larger swings in implied volatilities than options with longer maturities. Other option markets show other behavior. For instance, options on commodity futures typically show increased implied volatility just prior to the announcement of harvest forecasts. The market incorporates many other types of events into the term structure of volatility. For instance, the impact of upcoming results of a drug trial can cause implied volatility swings for pharmaceutical stocks. Generally, the term structure of volatility lists the relationship between implied volatilities and time to expiration and provides another method for traders to gauge cheap or expensive options. On the other hand, the volatility smile shows a variation of implied volatilities with a strike price. Traditionally, the FX markets exhibit a volatility smile, meaning that out of the money and in the money options have higher volatilities than at the money options, leading to a smile, while equity indices tend more to exhibit a skew, downward sloping, when volatility increases as strike prices decreases. The skew is a difference between at the money volatilities and out of the money or in the money volatilities. For standard options, there are standardized models like Black-Scholes. Input factors are strike, maturity, interest rate, spot price, and volatility. To get the right market price, we have to use the volatility the market is using, and that can only be derived from the last trades. The price of traded options is used in connection with the option pricing formula, e.g. Black-Scholes, to calculate the implied volatility. This volatility is then used to price other options, presenting us with a circular pricing conundrum. Unfortunately, where options of the relevant type or maturity are not traded, this technique is unavailable. If we combine the volatility smiles for multiple maturities, we can create a table or matrix whose elements represent volatilities for different strikes and maturities. The collection of implied volatilities for different strikes and maturities is called the implied volatility surface. The surface displays different characteristics for different markets and results from the probability of extreme moves. The above chart demonstrates an idealized shape of the volatility smile. Reality, however, often looks more complex. But why does the market adjust volatilities for different strikes? Traders are fully aware of the limitations of assuming a log-normal distribution in that the model does not fully assess the fat tails in the wings. The Black-Scholes model, therefore, underprices both call and put options that are either in or out of the money. Traders therefore need to tweak the volatilities in order to account for the fat tails. In practice, there are also supply and demand considerations along with market expectations built into option prices. For example, this pushes up the volatility for in-the-money or out-of-the-money calls relative to those of the put, thereby creating a skew. A risk reversal expresses the difference in volatility. In the FX markets, if a currency is expected to appreciate, calls would be favored over puts, and the purchaser of the call would pay a higher volatility relatively to the put. What final observations can we make? Firstly, let us consider the front end of the curve. The front end is less smooth than the long end. This is because implied volatility should reflect the market expectation of the average realized volatility during the option's life. Realized volatility of the underlying is often linked to certain events. For example, volatility on stocks tend to be high on the day the company reports its earnings. For short-term options, it makes a difference if an event day is incorporated in the option's life or not. Also, volatility for very short-term options is often very high. Short-dated options have high gamma and therewith high risk for sellers who want to receive compensation.